Hey everyone, we all want to make money, but when it comes to investing, two major players always come up: the stock market and real estate. On one side, you've got digital assets like stocks, and on the other, physical property you can actually touch. In the next 5 minutes, we're going to break both of these down and figure out which one might be the better fit for you. Let's get into it. 1. Investment. How much money do you need? Let's start with the entry barrier. How much money you actually need to begin. Stock market. You can start investing with as little as $10 or $50. Thanks to tools like fractional shares and automated investing plans, similar to SIPs, almost anyone can get started, even with a small budget. Real estate. This is a completely different game. Buying property usually requires tens or even hundreds of thousands of dollars. Sure, you can get a mortgage from a bank, but you'll still need a significant down payment upfront. Bottom line, stocks are accessible to almost everyone. Real estate typically requires larger capital and is better suited for higher income investors. 2. Profit returns. Now let's talk about the reason we're all here: returns. Stock market. If you pick the right investments, the upside can be huge. Historically, major indexes like the SP 500 have returned around 8 to 10% annually on average. Some individual stocks can grow much faster, but they also come with higher risk. And yes, markets can crash, so your portfolio can drop quickly too. Real estate. Real estate tends to offer slower but more stable growth. Property values usually increase over time. This is called appreciation. It's less volatile compared to stocks, which makes it feel safer for many investors. 3. Cash flow. Monthly income. Growing value is great, but what about actual cash in your pocket? Real estate advantage: rental income. If you own property, you can earn consistent monthly rent. It's one of the most popular forms of passive income. Stock market power. Stocks can also generate income through dividends, payments companies make to shareholders from their profits. However, dividends are not always consistent or guaranteed like rent. 4. Risk control. Here's something important you need to understand. Stock market. It's highly volatile. News, interest rates, global events, almost anything can move the market, and you don't have direct control over it. Real estate. You have much more control. You can renovate the property, increase rent, or even live in it yourself. It's a physical asset, which also gives many people a sense of security. Conclusion. So, who wins? If you have limited capital and want flexibility and liquidity, the stock market is a great choice. If you have larger funds and want a tangible asset with steady rental income, real estate can be powerful. But here's what most experts agree on: don't put all your eggs in one basket. A balanced approach, investing in both, can be the smartest strategy. If you enjoyed this video, hit that like button and drop a comment below. What's your dream investment? Owning shares in Apple Inc. or owning a condo in New York City? See you in the next video. Subscribe now for unlimited finance tips.